Today, the Fed just blinked. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. But today I wanted to discuss the latest Federal Reserve release, which has just come out. Because to my mind, this changes the game with regard to future expectations of financial markets and indeed even home prices here in Australia. And by the way, if you value the content we produce, please do consider supporting our efforts either via Patreon, here's a link, or by making a one-off donation via PayPal. Again, here's a link. We do appreciate your support, which enables us to continue to make great content. So the Fed made a release today, which essentially says that they're going to move into a patience mode, meaning now that future rate rises are now much less certain. And in addition, they've also underscored the fact that they will be prepared, if necessary, to go into quantitative easing mode again. So I think this is basically a victory for the markets, who, of course, at the end of last year, in the light of what the Fed was saying at the time, sold off very heavily in the US and indeed around the world. And I think that the Fed's reaction is particularly in response to those events. And of course, we know that Trump was less than pleased with the market movements. What the Fed also said in their release today was that they will continue to use the inflation targeting mechanism as the underlying guide to what they do, and that they're prepared to consider rate changes, either up or down, based on that, and also quantitative easing or tightening based on that. So basically, they've come back to a neutral setting and have tried to bring back all options to the table. This is what the Fed said. After extensive deliberations and a thorough review of experience to date, the committee judges that it is appropriate at this time to provide additional information regarding its plans to implement monetary policy over the longer run. Additionally, the committee is revising its earlier guidance regarding the conditions under which it could adjust the details of its balance sheet normalization program. Accordingly, all participants agreed to the following. First, the committee intends to continue to implement monetary policy in a regime in which an ample supply of reserves ensures that control over the level of the federal funds rate and other short-term interest rates is exercised primarily through the setting of the Federal Reserve's administered rates, and in which active management of the supply of reserves is not required. Second, the committee continues to view changes in the target range for the federal funds rate as its primary means of adjusting the stance of monetary policy. But the committee is prepared to adjust any of the details for completing balance sheet normalization in the light of economic and financial developments. Moreover, the committee would be prepared to use its full range of tools, including altering the size and composition of its balance sheet, if future economic conditions were to warrant a more accommodative monetary policy than can be achieved solely by reducing the federal fund rates. So what this says is that the Fed is prepared to go into QE mode again, if required. Now, this had an immediate positive impact on the markets. The Dow was up by about 2% today. And I think this does signal a significant change in direction. So my perspective is that going forward, we will not see any major changes to the Federal Reserve rate over the next few months. And that probably will flow on to a different pricing strategy into the financial markets, and it may indeed take a little pressure off some of the funding costs on Australian banks, for example. However, I don't think it will fundamentally tip the balance back to the point where Australian bonds are paying higher yields than US bonds. We've been in the situation until quite recently that's the case, but now, of course, we're in the situation where US bonds are paying higher rates. So funding costs in Australia will remain elevated for some time. But what I think this does signal, potentially, is that the can will definitely be kicked down the road, and that we will see a slower course of quantitative tightening than was originally expected. Therefore, the risks of a global liquidity crisis or even an international financial crisis has probably somewhat eased simply because the Fed will do less than expected. Now, I'm going to update my scenarios in a couple of weeks when I get the next set of data from my surveys. But it seems to me that this takes the probability of a global crisis down, and then we have to come back to Australia and consider the local economic data here, which continues to be rather troublesome. So the bottom line is this: I have not changed my 20 to 30% peak to trough fall in home price expectations in Sydney and Melbourne over the next 2 or 3 years. Now, that may change if the Royal Commission comes out with something shockingly different from what I expect, or if indeed we see funding costs changing significantly, or if we see considerable easing of lending standards. But I think the bottom line is that the global situation is probably a little less uncertain than it was 24 hours ago. If you like what you've seen here today, please share the post, like the post, add a comment or question. I read them all. And if you haven't subscribed, please do so to receive alerts to our latest posts. I'm Martin North from Digital Finance Analytics. Many thanks for watching. I'll talk to you again next time.